Our next two items this morning, both are related to bringing the SEC to the 21st century through technology. We have two proposals, one that would adopt XBRL as the interactive data standard for SEC reporting by public companies, and the other that would do so for mutual funds. First, let me explain this ledger, which is something that we can find a lot more of upstairs in the SEC's library. This was created by the SEC staff around the middle of the last century. It's fascinating to look at. It contains manually typed information for hundreds of public companies in scores of industries. When it was published, this was a useful report. This was when the SEC was less than a quarter century old. Few people use books like this anymore. Instead, we use computers to collect and analyze information from multiple sources. But computers aren't capable just of holding pages of books like this one. They contain information that can, if it's appropriately input, be mixed and matched in an endless variety of ways that make the data far more useful than pages of a book could ever be. Today we're considering rules to make information for investors that's now kept on SEC computers in nearly the same way as the information is kept in this book, universally accessible and useful to researchers, analysts, regulators, and investors around the world. Instead of being buried in ledgers and legal documents, it will be as free and accessible and as findable as any other information is today on the internet. About 30 years after publishing this ledger, the SEC began to move from paper document filing to electronic document filing. While electronic filing of documents was an improvement, it remains expensive and time-consuming to analyze and compare information that relies on what's filed in essentially an electronic filing cabinet. Today, we're not changing any of the information that public companies provide to the SEC or that mutual funds provide to the SEC. Instead, we're revolutionizing the way that they provide it, the format in which they provide it. We're taking the next step in this revolution from document disclosure to data disclosure. This information is going to enormously improve investors' ability to use that information. You can see where this information will be available today by visiting idea.sec.gov. For participants in the SEC's voluntary filer program, you'll find clearly labeled buttons taking you to their voluntary data submissions. And as soon as companies and funds make their mandatory submissions to the SEC's new IDEA system, you'll be able to get that data on idea.sec.gov. You'll also be able to view it at the websites of companies and funds disclosing the data and on third-party websites. Today's rules represent a giant step in the SEC's achieving its full disclosure mission. They make information more available to global capital markets. They make it easier to compare facts disclosed by companies and mutual funds. And they make it easier to compare the level of detail in corresponding submissions among similar filers. The SEC is based on the idea that investors are best protected when they can obtain full and timely disclosure of all material information about particular investments. Enron, WorldCom, and pervasive problems in the subprime mortgage industry all happened in part because important information wasn't available or fully understood by the markets. Instead, actual and potential liabilities and questionable assets were hidden in complex documents or not disclosed at all. False and highly speculative information was difficult for honest members of the financial reporting supply chain to detect and to discredit, and too easy for crooks to hide. Data disclosure isn't a magic insecticide to vanquish malicious termites intent on devouring our capital markets foundations. We haven't figured out how to put an exterminator's tent over the entire market without killing its healthy residents. But data disclosure will make the markets far more fair for honest participants, hostile to termites, and cleaner for all investors. Unlike document disclosure, data disclosure helps analysts, financial journalists, and regulators find red flags, and it makes it easier to detect missing information. This is because data analysis is faster, cheaper, and more accurate than document analysis. In recent years, computer analysis of options dating protected millions of investors from undisclosed dilution of their holdings. This was possible only because the options data was reported to the SEC for the first time in XML format, the basis of the standard we're adopting today. In the same way, the ability of markets to access data about finances, risk, conflicts of interest, and holdings, combined with continuous improvement in analytical tools and processes, will help our markets recover from today's dearth of confidence. Faster, better, and less expensive information will improve risk analysis to help prevent or mitigate future asset bubbles. Bubbles can be based on fraud, ignorance, or a hybrid of defects such as those from which today's markets are struggling to recover. The faster and more effectively the information underlying the markets can be analyzed, the lower the dangerous heights from which investors may fall. The SEC did not invent interactive data. We are simply requiring that companies and mutual funds report in this format. Like ASCII and HTML, in which the SEC already requires companies to file, interactive data is nothing more complicated than a computer language. But if we embrace its potential, it can revolutionize the benefits that investors derive from corporate and fund disclosures. In the 1930s, the accounting profession helped prepare the forms and other papers, as the term was put, for companies to disclose key financial information in industry standard formats. It took years for that work to kick in, but when it did, structured accounting disclosure helped American public companies roar to life and gave the United States the world's strongest capital markets. Today, the accounting profession has contributed not just forms and other papers, as it did in the 1930s, but internet tags and best practices. Accountant and technologist Charlie Hoffman and the American Institute of Certified Public Accountants merit particular recognition for helping bring XBRL to life. Just as the accounting profession helped restore market confidence with U.S. GAAP disclosure standards, helping investors extract better information from companies, it will also help investors get better information in the 21st century. Interactive data will enable analysts at the SEC and in private industry to vastly improve their comparative analytical capabilities. It will replace today's time-consuming and error-prone work to retrieve information with systems that put key information at every investor's fingertips within seconds, exactly as the investor wishes to see it. It will encourage the development and improvement of new analysis tools that will better investment decisions. Nothing could serve the SEC's mandate better than to provide investors with the information they need rather than just the forms on which to try to find it. Interactive data will also address growth in the economy's size and complexity. In recent decades, information that's required for full disclosure in 10Ks, 10Qs, and other commission forms has grown dramatically in volume and complexity. Despite this expansion, the information disclosed has at times proven inadequate. Paper and even electronic representations of paper simply can't keep pace with financial engineering and digital capital markets. Today, investment bubbles grow at internet speed. It's vital that the SEC have every tool possible to get the information needed by investors to burst those bubbles, before a bursting bubble undermines market trust and confidence. In this respect, the SEC's experience in developing a business process to successfully complete the data tags for more than 15,000 concepts in U.S. generally accepted accounting principles in a few short months may be invaluable. Federal Reserve Board Governor Randall Kroesner, Edgar Online President Phil Moyer, and others have said publicly in recent months that mortgage-backed asset disclosure in data format could help restore that market. By all accounts, improving the way asset-backed securities data is disclosed and processed may be even more critical to future economic growth than data tagging U.S. GAAP. It would be remarkable but not surprising were the experience of creating U.S. GAAP data tags to serve as precedent and catalyst for asset-backed securities data tags. We should look forward to that day. In January 2005, the Commission unanimously approved Reg AB. In doing so, it was reacting to dramatic growth in the asset-backed securities market and codified 2 decades of interpretive guidance governing the disclosure of information about these securities. Unfortunately, the technology to structure disclosure about those securities didn't exist in 2005. Today, it does. As we meet, XBRL US, the organization responsible for the U.S. GAAP and mutual fund tags we are considering today, has developed prototype data tags for residential mortgage-backed securities. These data tags could be used to bring the same type of structure to these instruments that U.S. GAAP brought to public company financial reporting. Enron, WorldCom, and the subprime crisis as I said, happened because assets could be overstated and liabilities concealed from investors. In the case of public companies, the SEC and Congress worked together to remedy those defects with the Sarbanes-Oxley Act. In the case of asset-backed securities, those responsible for regulating asset quality have used a variety of proprietary data standards, but until now, we lack the vision and technology to improve disclosure about those assets. Today, because the vision and the technology exist, we can replace private proprietary ABS disclosure with an internet-based open data standard available for review and suggested improvements by every investor, analyst, academic, and regulator with an internet connection. And we can make it easier for both individual investors and sophisticated analysts and institutions to value these securities. Little could be more important to the well-being of investors and the health of the economy. On December 3rd of this year, the Commission approved and proposed several rules to improve the ability of credit rating agencies to analyze asset-backed securities, including rules requiring the disclosure of particular information in interactive data format. Credit rating agencies, as well as investors, will benefit from getting more information in interactive data format. Today's rules call for data tagging of public company financial statements and mutual fund risk return summaries. Nearly 90 million individual U.S. investors hold $10 trillion in total mutual fund assets. Interactive data will let these and new investors comparison shop to get the investment product they want at a competitive price. Today, we're also adding a voluntary program to permit mutual funds to disclose holdings in data format. Customers of funds that do this and the investment professionals who advise those customers will find that this makes it easier to compare the performance of mutual fund managers, which is a key criterion that retail investors use to differentiate among the thousands of mutual funds available to them. Finally, let me offer a few words about the future. It was only possible to publish this book, Data on Profits and Net Worth, because the SEC required the disclosure of the information that it contains in the first place in an industry standard format. As it did so, the Commission set the stage for the United States to lead the world with our powerful 20th century capital markets. The development of U.S. GAAP and of standards to make mutual fund disclosure useful as well were critical to the growth of both U.S. capital markets and the growth of the SEC to preserve trust in those very markets. Today, however, we are suffering a retrenchment in confidence. This retrenchment originated not from inadequate public company disclosure or from inadequate mutual fund disclosure per se, but from inadequate disclosure about asset-backed securities, certainly, and in particular, residential mortgage-backed securities. Interactive data is in the process of freeing businesses from manually creating reports across the economy. It frees up time and resources for the business of doing business instead of the business of reporting. Interactive data reduces the risk of error and fraud, something that we have seen time and again as we have explored this process. Interactive data helps managers and regulators detect and correct mistakes, and it will free investors from the drudgery of manually manipulating the data to allow more time to make more thoughtful investment decisions. If experience has taught us anything, it's that no single government agency or no single company, and certainly no single individual, can on his or her own gather and analyze sufficient information to completely mitigate systemic risk. Only transparent, open markets with ample doses of the fundamental ingredient of working markets, information, adequately protect investors and every participant in the economy who depends on investors. Today's final rules are thanks to the hard work of a matrix of staff across the SEC. It's truly been an interdisciplinary effort. That includes particularly David Blaskowski, Jeff Nauman, Walt Hampshire, Joel Levine, Linda Lee, and Ted Eulinger from the Office of Interactive Disclosure. It includes John White, Maury Osterhoff, Craig Slivka, Mark Green, and Jim Lopez from the Division of Corporation Finance, along with several others. In the Office of the Chief Accountant, Conrad Hewitt, Jim Croker, Paul Beswick, and Jeff Minton. Lou Walker, Srini Bangarbale, and Rick Heroux from OIT. Brian Cartwright, Andy Volmer, and David Fredrickson from the Office of the General Counsel. And from the Office of Economic Analysis, Jim Overdahl, Cindy Alexander, Chuck Dale, and Scott Baugus, Mark Story and Kevin Callahan from OPA, and Jonathan Sakobin from the Office of Risk Assessment. In the Division of Investment Management, I'd like to thank Buddy Donahue, Brent Fields, Mark Berman, Tara Buckley, Deborah Skeens, and Alberto Zapata. And finally, I'd like to recognize the work and dedication of the councils for each of the commissioners and the commissioners themselves, including two councils in particular who have devoted countless hours to this project, Christy Romero and Hunter Jones, as well as Paul Wilkinson. Collectively, you have developed two solid rules that promise great benefits to investors. The Commission and investors are grateful, and we thank you very much. So I will now recognize John White to explain the rule for public companies, and then Buddy Donahue to discuss the rule for mutual funds.